the $250K, Matrix, How to Hijack 0%, Business Credit Stacking. Listen, what if I told you that you could walk into major banks right now, pull out $250,000 at 0% interest, and they wouldn't even ask what you're spending it on? Before your brain automatically cataloged this under online scams, let me clear the air on what this is not. This is not a standard bank loan. There are no equity-hungry VC investors involved. And this is definitely not an SBA application that wastes 6 months of your life just to hit you with a generic rejection letter. What we are talking about is strategic business credit card stacking. Executed properly, it means layering specific institutional lines of credit in a highly calculated sequence over a strict 3 to 4 week window. I've personally shepherded over 100 entrepreneurs through this exact pipeline. The average yield across the board sits right at $175,000. My fastest execution hit $122,000 in 19 days. The absolute peak I've personally verified was a staggering $410,000 spread across 14 distinct cards for a medical spa owner out in Scottsdale. Most people will watch this, scroll away, and do absolutely nothing because it sounds too simple to be legitimate, but it is entirely real. I'm pulling back the curtain on the entire blueprint today because the information deserves to be free. The baseline requirement before you submit a single application is pulling your credit reports from annualcreditreport.com across all 3 major bureaus. It costs nothing. We aren't looking at your credit score here. We are actively hunting for underlying liabilities that trigger automatic algorithmic denials before a human underwriter ever sees your name. There are 5 primary liabilities that routinely dismantle otherwise flawless applications. First, a tiny $500 collections account from 3 years ago that you completely forgot about. That minor blemish alone will instantly kill a Chase application. Second, credit utilization exceeding 15% on any single individual card. The algorithms look at per card utilization, not just your aggregate limit, which is a nuance almost everyone misses. Third, having more than 2 hard inquiries within the last 6 months on a single bureau. Fourth, an address mismatch between your driver's license and your active credit file. Banks immediately flag this as identity fraud and terminate the application. Finally, a frozen Innovis or LexisNexis file. These secondary data bureaus are heavily utilized by institutional fraud departments during the background verification phase. You need to sanitize your report first. Eradicate the collections, pay down every individual card below 10% utilization, synchronize your physical address across all 3 bureaus, and ensure your LexisNexis and Innovis files are unlocked. This remediation phase can take anywhere from 6 to 24 weeks, but it represents the literal difference between walking away with an $80,000 approval or a $250,000 cash injection. I have watched applicants get denied for a modest $25,000, spend 30 days scrubbing their file, reapply with the exact same stated income, and walk away with $135,000. The person didn't change, the data integrity did. If your score currently sits below 700, do not proceed with the stack. You need to stabilize your baseline score first, which can be managed directly through scalewithcredit.io. If you need an accelerated point boost, the absolute fastest compliant method is getting added as an authorized user on an immediate family member's oldest trade line. The entire unblemished payment history replicates onto your report, which frequently yields a 60 to 100 point increase within a single billing cycle. For severe negative marks dragging down your profile, there is an aggressive compliance methodology utilized by high-end credit repair firms. Under Fair Credit Reporting Act, Section 605B, credit bureaus are legally required to block information resulting from identity theft within 4 business days. By filing an official report at identitytheft.gov, capturing the reference number, and issuing a formal 605B block request to all 3 bureaus alongside your identification, the bureaus must suppress those disputed items inside that 4-day window. This is vastly superior to the standard 30-day dispute process. While filing a deceptive report constitutes a federal offense, understanding that this high-velocity statutory tool exists is critical for navigating the landscape. For non-fraudulent standard negative items, the play is a strategy known as bureau flooding. You simultaneously issue disputes to all three bureaus and directly to the data furnisher. The law mandates a 30-day verification window. Because institutional compliance departments are chronically understaffed, they often fail to respond within the statutory time frame, triggering an automatic statutory deletion. Layering that with a formal Consumer Financial Protection Bureau complaint forces the creditor to manage 4 concurrent investigations. Their compliance teams typically opt for a deletion rate between 60 to 80% just to mitigate administrative overhead. Pairing bureau flooding with an authorized user trade line can realistically shift a profile from a 580 to a 720 plus within a 60 to 90-day window. I've executed this and monitored its success dozens of times. Once you hit that 720 threshold, bank approvals become incredibly aggressive. Now, let's break down the execution of the actual stack. Banks pull data from different bureaus, and fresh hard inquiries are instantly visible to competing institutions. If Bank B sees you shopping for credit at Bank A, your risk profile spikes and they deny the file. The precise order of your applications determines whether you secure $50,000 or $250,000 on the exact same underwriting profile. Week 1 belongs exclusively to American Express. Amex does not initiate hard inquiries on existing cardholders. If you hold a single active piece of Amex plastic, you can stack 3 to 4 business cards sequentially, and 0 new hard inquiries will register on your consumer report. Competing institutions will remain completely blind to the fact that you just extracted $80,000 in liquidity from Amex. If you don't have an established relationship with Amex yet, this will be your single necessary hard pull. Get it out of the way immediately. Utilize their Apply with Confidence feature, which evaluates your profile via a soft pull and confirms approval before you ever commit to a hard inquiry. The targets here are the Blue Business Plus and the Blue Business Cash, both offering 0% interest for 12 months with limits extending up to $50,000 with no annual fees. You also want to target the Business Gold, which features no preset spending limit and is an absolute necessity if your operation scales through high-ticket inventory or media spend. Apply for all of them within the same business week. Amex heavily weights internal relationship history over raw FICO scores. An unblemished 2-year history with them unlocks massive limits. Expect an aggregate yield between $25,000 and $75,000 from this initial phase. Week 2 is dedicated entirely to Chase. Chase enforces the strict 5/24 rule, meaning an automatic rejection if you have opened 5 or more personal credit cards across any issuer in the past 24 months. Business cards from external issuers generally do not count toward this ceiling, but Chase's personal lines do, though this can occasionally be bypassed via an internal relationship manager. Chase primarily pulls Experian data. Because your Amex stack from week 1 didn't leave a footprint on your Experian file, your profile looks completely pristine to Chase's underwriting algorithm. You will target the Inc. Business Suite. The Inc. Business Preferred doesn't carry a 0% promotional window, but spending $8,000 in 90 days yields 100,000 ultimate rewards points, valued at over $1,250 in cash equivalent, with typical limits hovering between $25,000 and $40,000. The Inc. Business Unlimited gives you 0% for 12 months, with limits landing between $50,000 and $75,000. The Inc. Business Cash provides another 0% window for 12 months, pushing limits between $100,000 and $125,000 if you structured the previous sequences correctly. You can hold all 3 concurrently, provided you strictly adhere to this order. Week 3 is about collecting the remaining liquidity. Each subsequent bank will chip in $15,000 to $25,000. Look at the US Bank Business Platinum for 12 billing cycles at 0%. the Wells Fargo Signify Business Cash for a 12-month 0% window, and the PNC Business Visa, which offers 0% for 13 months covering both new purchases and balance transfers. The Truist Business Card offers strong limits, but because they initiate a hard pull across all 3 credit bureaus, they must be saved for the absolute end of your sequence. Select 2 to 3 of these options based on which of your bureaus possesses the fewest inquiries after the chase execution. Expect another $30,000 to $75,000 here. The final architecture of the stack looks like this. Amex yields $50,000 to $100,000. Chase delivers $30,000 to $75,000. The remaining issuers contribute another $30,000 to $75,000. That lands you between $110,000 and $250,000 in 0% capital across 6 to 10 corporate accounts, completely finalized inside of a month. None of these accounts report their ongoing balances to consumer credit bureaus. Your consumer FICO score remains untouched and occasionally increases because your total available credit lines have expanded while your consumer utilization drops to 0%. You are effectively carrying $250,000 in working capital while your consumer report explicitly states you owe nothing. Now, let's address the obvious operational hurdle. Credit card limits are not liquid cash. You need to convert those lines into liquid bank deposits. This liquidation process carries a transaction fee between 2 and 3%, but it routes capital directly into your operating bank account within 48 hours. Method 1 is utilizing business payment processors like Plastic or Melio. These platforms allow you to settle lease agreements, inventory invoices, or vendor costs using a credit card while they distribute the capital via ACH or physical check. The standard fee is 2.85%, and you route the payment to an independent corporate entity you control. Method 2 is running transactions through your own merchant accounts via Stripe or Square. The capital clears into your business bank account at a cost of 2.9% plus 30 cents per transaction. Many operators establish distinct e-commerce stores solely to facilitate this pipeline. Method 3 is the cleanest and most cost-effective alternative: federal tax overpayment via pay1040.com. Processing fees range from 1.85% to 1.98%. You deliberately overpay your estimated corporate or personal tax liabilities using the 0% cards, and then claim the overpayment as a cash refund check from the IRS when you file. The IRS fundamentally does not care how their payments are processed. On a $200,000 credit stack, your total blended liquidation cost hovers around $4,000 to $6,000. Let's look at market alternatives for context. An SBA loan will run you anywhere from 6 to 10% APR, costing $12,000 to $20,000 annually in pure interest. A merchant cash advance carries predatory effective rates between 40 and 80%, draining $80,000 to $160,000 a year in fees. Venture capital requires giving up 10 to 25% of your actual equity, costing you millions in long-term upside. Instead, you just secured $200,000 for a flat $5,000. By month 10, your 12-month introductory 0% windows will begin to expire and standard interest rates will apply. This is where you execute balance cycling. Because your consumer credit score is completely unburdened by this corporate debt, your profile remains optimal. You initiate a secondary round of applications for fresh 0% corporate cards at entirely different banking institutions. Once approved, you utilize the new 0% capital to completely liquidate the balances on the initial round of cards. The 0% interest clock resets for another 12 to 18 months. The original accounts return to a zero balance, the new accounts assume the debt, and your net interest paid to the banking system remains exactly zero. I've seen operators run this cycle continuously for over 5 years. An associate of mine out in Austin has been rotating $200,000 in operational capital for half a decade. Her total carry cost sits at roughly $5,000 a year in transaction fees, saving her upwards of $20,000 annually compared to traditional commercial financing. The banks are banking on the fact that you will miss the expiration dates and get hit with a 24% APR penalty. You avoid this simply by maintaining an automated spreadsheet tracking every promotional window 18 months out. If you want to ensure this executes flawlessly, avoid these critical operational errors. Do not apply out of sequence. If Chase pulls your file and identifies 4 fresh inquiries from the previous week, your file is dead. Amex must always go first. Do not apply without a formalized corporate entity. You need an active LLC or sole proprietorship. Setting one up takes 20 minutes and a nominal state filing fee, and an EIN can be secured from irs.gov for free in 5 minutes. For banking purposes, classify your enterprise under consulting or marketing services. When entering annual revenue, confidently utilize your projected next year gross income based on your capitalized capacity. Do not initiate the stack with consumer utilization north of 10%. Clear all personal credit card debt beforehand, or banks will assume your corporate application is an act of financial desperation. Never panic after an isolated denial. Underwriting models vary wildly. An automated rejection at Capital One can easily be followed by a $40,000 approval at Amex within the exact same business day. Finally, optimize for institutional calendar quarters. Banks operate under rigid quarterly lending quotas mandate by corporate regulators. During the final 2 weeks of March, June, September, and December, underwriting parameters systematically loosen to satisfy volume requirements. The final 2 weeks of December are uniquely profitable because institutions are aggressive about hitting their fiscal year-end lending targets. Timing your stack to this specific window drastically escalates your approval ceilings. The banking system engineered these 0% products specifically to catch you off guard and trap you in high-interest consumer debt. Stacking is simply the process of reading their underwriting rulebook and using their own capital deployment systems to fund your business. The blueprint is yours. Execute cleanly, keep your data tight, and I'll see you on the next one.